Special thanks to Cambridge House and Vancouver Resource Investment Conference for inviting me back for another year. We are meeting at a moment when the mining sector is very much loudly entering one of the most consequential investment cycles of the last generation. After decades of undercapitalization, supply chain fragility, and increasing geopolitical fragmentation, capital is finally rotating back into hard assets, and mining is once again being recognized as a strategic industry. I've kind of renamed the title of this topic to this, How to Go Broke in a Bull Market. And I want to start with the simple but uncomfortable truth. Most investors don't lose money in bear markets. They lose it in bull markets. Bear markets are honest. Liquidity disappears, prices fall, risk is obvious, and fear keeps people cautious. Bull markets, on the other hand, are deceptive. Everything looks like it's working, charts go up, stories sound convincing, and spreadsheets look incredible. And that's exactly when discipline heads for the exits. We are entering what appears to be a powerful and structural bull market for commodities and mining. Capital is rotating in, governments are involved, institutions have returned, and the setup is real. But the phase of the cycle is also where investors make their largest, most permanent mistakes. And today I want to talk about how that happens and how you can avoid it. Before we dive in, just a little quick word. I'm the host of the Mining Stock Daily podcast, and I'm also the CEO of the Clear Commodity Network, which is a new network of podcasts, not just on mining content, but also throughout the commodity space, oil, energy, uranium, battery metals, agriculture, and the like. The Vantage Point gives us a unique and broad perspective on how capital is behaving and where attention is shifting and what investors are truly demanding from the mining sector today. What that gives us is pattern recognition. And we see the same deal structures, the same financing terms, the same narratives, and the same mistakes, cycle after cycle, just with different company names and higher price assumptions. Only the prices change. The behavior does not. So let's chat about one of the first lessons we've learned and some of the glimpses of a bull market where we've had over the past decade. Here's the first lie a bull market tells investors. Everyone is making money. You should be too. It's never actually true. What's happening instead is that risk is being mispriced and momentum is being mistaken for skill. Rising prices get confused with good business. Compelling stories get confused with durable assets. Bull markets don't expose bad ideas immediately. They carry them. And that's why the damage is so severe when cycles turn. So let's start with capital flows themselves, because they're reshaping the entire landscape. The United States and the federal government have become one of the largest, most influential investors in mining. The Department of War is taking equity stakes in rare earth and critical mineral projects. The Department of Energy is funding midstream capacity for copper, lithium, nickel, and the like. And through the Inflation Reduction Act, the bipartisan infrastructure law, and President Trump's One Big Beautiful Bill, billions have been earmarked for domestic materials essential to electrification, national security, and industrial competitiveness. This is not abstract policy. This is capital formation. It's active capital formation. It is strategic, with clear political and economic objectives to secure supply, de-risk domestic production, and strengthen the U.S. position in a multipolar world. But here's where investors make critical mistakes. They assume that if a government is involved, risk has been removed. It hasn't. Government capital doesn't care about dilution. It doesn't care about IRRs. It doesn't care if public shareholders get wrecked. It cares about supply. If you confuse strategic relevance with investment safety, you're already halfway to going broke. And at the same time, institutional capital is running after a long absence. Pension funds, private equity firms, sovereign wealth funds, and like, even large asset managers, many of which exited this sector from the last cycle, are quietly increasing exposure. That's notable. But the tone is they're not chasing speculative production growth. They want structured discipline milestone-driven investments that withstand volatility. And in other words, capital is available, but the expectations attached to it are far higher than the previous bull cycle. So to understand those expectations, let's talk about what we learned in the last cycle. The last super cycle that peaked in 2011 created enormous opportunities, but it also created enormous mistakes. Companies overspent, mega projects saw CapEx blowouts, and they destroyed returns. Developers pursued production growth for the sake of growth and diluting value and eroding margins. Acquisition discipline disappeared. Equity issuance diluted long-term holders, timeline slipped, communication broke down. I think you all see the picture of what happened. Ultimately, investors got burnt. After the cycle ended, the mining industry spent more than a decade rebuilding its credibility. The core lesson investors now carry is simple. Discipline matters more than volume. They will reward companies that generate durable margins, stick to realistic timelines, manage risk, and focus on humility. They will punish companies that repeat the sins of the past. So the new cycle comes with old memories, and smart companies are embracing that. So what are institutional investors looking for this current cycle? First, they want clear, credible, staged path to free cash flow. Not a dream, not a marketing slide. They want a concrete de-risk plan with milestones that can be communicated and met. They expect strict capital discipline, especially on operating and construction costs. They have no patience for the 2011 style blowouts that we saw back then. They want technical sound studies, PEAs, feasibility studies built on conservative commodity prices, realistic throughput assumptions, and credible timelines. They're investing in management teams. With experience and a track record of leadership. Permitting, engineering, community relations, M&A judgment, it all matters. Capital is no longer betting solely on geology, it's betting on execution. And finally, they want offtake. Whether it's utilities and uranium, OEMs, or battery metals, or smelters and copper and zinc, investors want to see alignment with users. So institutional investors are screening for policy alignment, projects that strengthen domestic supply chains, support energy security, and fit federal or state strategic priorities. And across all this means transparency. It's a must. It's the new currency of trust in this sector. Retail and high net worth investors operate differently. They want torque, they want exposure to rising prices, they want exploration success and optionality. But they also want responsible behavior from management. Limited dilution, strong insider ownership, clear catalysts, and a simple, coherent story to understand. But these expectations in a broader macro backdrop, that is driving the bull market itself. First, we're facing the consequences of a decade of underinvestment. From 2012 to 2011, exploration budgets collapsed, development projects were deferred, and global inventories dropped. Today, deficits are emerging across copper, uranium, silver, and other critical minerals. The U.S. and its allies are reindustrializing. Electrification, AI-driven power demand, grid updates, data centers, new manufacturing corridors, they're all creating the baseline metal demand that didn't exist a decade ago. Third, geopolitics has fundamentally shifted. North American and allied jurisdictions now carry a premium because they offer predictability, rule of law, and supply chain security. Permitting is becoming more transparent globally. That increases the scarcity value of U.S.-friendly jurisdictions with stable regulatory frameworks and reliable labor force. Investors expect mining companies to understand these dynamics and articulate why the project matters in this macro environment. But there's another important factor we need to talk about. That's because it's especially relevant during a strong precious metals market. The risk that high metal prices will distort judgment. When gold is 3,000, 4,000, 5,000, pick a number higher than 2,500, and silver is breaking out, almost every project looks pretty damn good on paper. IRRs expand, paybacks shrink, and marginal deposits start looking like winners. It becomes tempting for companies to believe the economics justify moving into development, and equally tempting for investors to assume the market needs all of these projects. But the hard truth there is that they don't. The industry does not need, and the market will not fund, every project that screams as economic at high spot prices. This is exactly how the last cycle became inefficient. High prices produced a false sense of security. They made marginal assets look competitive. They masked permitting challenges, metallurgy issues, infrastructure gaps, and management weaknesses. And too much capital chased too many projects simply because the spreadsheet said it worked. Investors need to learn from that. In today's market, they have to ask tougher questions like, does the project work at conservative prices or not? Does it have structural advantages? Does it have grade, jurisdiction, scale, cost production? Does the project matter? Does it solve a supply deficit? Does it serve a strategic need? Or is it simply additive but unnecessary? Can management actually build it? Many deposits look promising. Far fewer have teams capable of construction and operations. So yes, high metal prices help the sector. No arguing that. But they also encourage a wave of marginal projects that do not deserve capital. Investors are countering this risk by focusing only on the highest quality assets, the projects that can survive at $1,600 gold, that have genuine grade or jurisdictional advantage, and that contribute meaningfully to long-term supply needs. High prices do not eliminate the risk in this sector. They camouflage it. They hide bad metallurgy, hide bad permitting nightmares, hide weak balance sheets, hide management teams that have never built anything. The most dangerous words in a bull market are, this time is different. The price is higher. It's one of the biggest investor expectations in a new bull market. Just because the prices are high, your discipline must be higher. So in this part of the cycle, mining companies need to think of the metals market as the way a grandmaster thinks of a chessboard. Prices will move, sentiment will shift, and geopolitical tension will occasionally knock the pieces out of alignment. But ultimately, the miners are the ones making the decisive moves. They are the players with real agency in this cycle. Every capital allocation decision is a move. Every dilution event is a sacrifice. Every ignored risk weakens your position. The Winter Street bull market's like a disciplined opening. Controlled, defensive, and very much patient. The ones who go broke play blitz chess and hope the clock never runs out, which I would say is what I'm witnessing this week. Predictability is the miner's checkmate. Investors can handle volatility, but they cannot handle chaos. The companies that set expectations, meet them consistently, and adjust their strategy with discipline that will not just react to the board, they will control it. In this bull market, the winners won't be the ones hoping the board breaks their way. They'll be the ones shaping the game. So in closing, there's tremendous opportunity ahead. I don't want to be up here saying doom and gloom. I think the ultimate word is check your discipline, because your discipline and your expectations need to be in line and more in tune than ever before. We are at the beginning of a generational investment cycle in this mining sector. One driven not only by market forces, but by strategic necessity. For the first time in decades, government capital, institutional capital, and private capital are all moving in the same direction. I didn't think I'd ever see it in my lifetime. I'm not even that old. The companies that learned the lessons of the last bull market, the companies that prioritize discipline, transparency, and alignment, they will be the ones that capture outsized opportunity in this cycle right now. Mining's always been cyclical. We've all known that. But this time, it's also structural. And the investors coming to the space are clear about what they expect. The companies that listen and execute stand to define the next decade of North American resource development. And for investors out there listening, you have to remember this. Bull markets don't make people rich by default. They reveal who already had the discipline. Okay, thank you so much. Appreciate it. Enjoy your week.